This video will explore the key option Greeks: delta, gamma, theta, vega, and rho. These factors affect the price of an option, and therefore, if you are an option trader or aspiring to become one, a deep understanding of these is essential to successfully apply them. Option Greeks factors delta. The first Greek is delta, which quantifies how much an option's price is projected to fluctuate for every $1 that the underlying securities or index changes in price. A delta of 0.50, for example, indicates that the option's price will fluctuate 50 cents for every $1 movement in the price of the underlying stock or index. Call options have a positive delta since the value of a call option increases with an increase in the price of the underlying asset. Similarly, put options have a negative delta since the value of a put option decreases with an increase in the price of the underlying asset and vice versa. The value of delta oscillates between 0 and 1 for a call option and between -1 to 0 for a put option. The value of delta for an at-the-money ATM option is usually close to 0.5 for a call option and -0.5 for a put option. Now, the value of delta approaches 1 or -1 as the moneyness of the call or put option increases respectively. Deep in the money call options have a delta close to 1 and deep in the money put options close to -1, since the price of a deep in the money option seeks to behave almost exactly as the underlying asset. Similarly, out-of-the-money options have delta close to 0 since there is a very high probability of such options to expire worthless. As we get closer to expiry, the delta of options tends to 0 because the time remaining for any significant move in the underlying asset tends to 0. Gamma. Assuming the underlying asset to be displacement, delta is speed and gamma is acceleration. The first derivative of the underlying asset, WRT time, gives us delta, and the second derivative of the underlying asset, WRT time, gives us gamma, or the first derivative of delta, WRT time, gives us gamma. Delta is only accurate at a specific price and at a specific moment. The delta in the previous example is no longer 0.50 once the stock has moved $1 and the option has moved 50 cents. As previously indicated, a $1 move would push a call option farther into the money, bringing the delta closer to 1.00. Assume that the delta is now 0.6. This is a 0.1 increase in delta from 0.50 to 0.60. In this case, the option's gamma would be 0.1. Now, if the stock moves further more into the money, the delta will tend to 1 but at a decreasing rate, so essentially the gamma would decrease slowly so as to make the delta tend to 1 but not exceed 1. Theta is the option buyer's biggest enemy and an option seller's best friend. Theta is a measure of the time decay prevalent in options. The time component is as important as the price of the underlying asset as a factor in the determination of an option's fair value. Theta is not linear in nature. It increases significantly as the option approaches expiry. Intuitively, it can be seen that as the time to expiry decreases, the time available for the underlying asset to make any sort of big moves decreases. This increases theta, and the price of the option decreases. This is one of the primary reasons that most of the options end up expiring worthless, and most of the option buyers end up losing their money. Vega. Apart from the price movement of the underlying asset and time, volatility is an extremely important factor that influences the price of an option. Vega takes into consideration this measure, and even though it is not an actual Greek letter, it is an important and widely used Greek in option trading. The rate of change in an option's price per 1% change in the implied volatility of the underlying stock is measured by vega. Since an increase in volatility enables the underlying asset to make wide swings, this is factored into the price of an option through vega. A decrease in vega causes both call and put options to lose value, while a rise in vega causes both call and put options to gain value. Generally speaking, it is a good idea to buy options when vega is below the normal levels, and it is a good idea to sell options when vega is above the normal levels. This is because any contrary change in vega will cause the respective party good gains. This is essentially a contrarian strategy in its most basic form and is generally used along with a variety of other tools.